Carmax issued a $4.8 billion warning, and the used market industry lost 67% of its value virtually overnight. Picture this. You buy a used car, and overnight its value crashes by 2/3. Dealers panic. Trade-ins collapse. People who relied on car equity to pay bills are suddenly underwater. That's not a slow slide. That's a market nuked in months. Here's what makes this terrifying. A single move from a giant buyer can flood auctions, crush prices, and wipe out small dealers. But there's a twist no one expected. Strange pricing shifts, secret wholesale dumps, and a shadow strategy that looks like it's forcing values down on purpose. Some insiders say the $4.8 billion hit is just the start. We'll show you the data, the patterns dealers won't talk about, and one hidden mechanism that could make your car worth nothing tomorrow. Was this a calculated market hit, or a monster mistake with consequences for millions? Carmax stands alone at the top of the used car industry. With over 240 stores in operation and a footprint stretching across nearly every major metro area, their reach is unmatched. No other retailer moves as many used vehicles or has as much control over both retail and wholesale channels. Every week, Carmax runs dealer-only auctions in dozens of cities, moving hundreds of thousands of cars per year through their own pipeline. When they adjust prices or shift inventory, the rest of the market feels it, fast. This isn't just about selling cars to regular buyers. Carmax is the largest single source of wholesale vehicles in the country, feeding inventory to smaller dealers who can't buy direct from the public at scale. Their auction blocks set the tone for what dealers will pay on Main Street and what lenders will finance on the back end. If Carmax raises a price, the Mannheim Market Report ticks up. If they cut loose a batch of aging inventory, local lots scramble to keep up. That's real pricing power, and it's built on a model nobody else can match. Their integrated approach means Carmax owns each step, sourcing cars from consumers, reconditioning them in massive centers, selling to retail buyers, or, if a car doesn't fit their standards, dumping it through their own auctions. This cycle repeats hundreds of thousands of times a year. In fiscal 2025 alone, Carmax sold about 790,000 used cars at retail and another 540,000 at wholesale. That's over 1.3 million vehicles, roughly 4% of all used cars changing hands in the US last year. It's enough volume to move the needle nationally. For independent dealers, Carmax's scale is a double-edged sword. On one hand, their auctions are a lifeline for fresh inventory. On the other, their pricing sets the ceiling and the floor on what any small lot can pay. When Carmax decides to drop prices, everyone else gets squeezed. If they hold back inventory, supply tightens and values rise. It's a game where the biggest player always has the best cards. Most Americans don't realize that a handful of decisions made in a Richmond, Virginia boardroom can ripple through every auction lane in the country. But that's the reality. Carmax is the bellwether for the entire industry. Their numbers are watched by Wall Street, lenders, independent dealers, and even automakers trying to manage their own certified pre-owned programs. When Carmax coughs, the rest of the used car world catches a cold. And right now, everyone's watching for the next move. In 2021, the used car market flipped upside down. New car production lines stalled as semiconductor shortages rippled through factories from Michigan to Japan. Dealerships that once overflowed with inventory now looked like empty lots. For the first time in living memory, used cars didn't just hold their value, they shot up. Some models, like the Toyota Tacoma or Honda Civic, actually appreciated. Buyers lined up for vehicles 2, even 3 years old, sometimes paying more than the original sticker price. Dealers couldn't keep cars on the lot for more than a few days. The Mannheim Used Vehicle Value Index, the industry's main benchmark, hit record after record. By June 2021, it was up nearly 50% from pre-pandemic levels. The supply crunch was relentless. Automakers built fewer than 14 million new vehicles in 2021, down from nearly 17 million in 2019. Rental car companies, desperate for fleet replacements, started buying used cars at auction, competing directly with retail buyers. Suddenly, every dealer was fighting for scraps. Carmax, with its national reach and direct-from-consumer sourcing, could outbid nearly everyone. Smaller lots either paid up or got shut out entirely. Consumers felt the squeeze. A family looking for a 3-year-old SUV found prices up $8,000 from just 2 years earlier. Even high-mileage vehicles, once the discount option, became hot property. Loan terms stretched out, down payments ballooned, and monthly payments climbed to record highs. Lenders adjusted, but with every jump in price, the risk of negative equity grew. The market was running on fumes. Everyone knew these prices couldn't last, but no one wanted to miss out. Dealers stocked up, betting the shortage would drag on. Buyers rushed to lock in a car before values climbed any higher. For a brief moment, it looked like used cars were a safe bet, a hedge against inflation, a store of value. But beneath the surface, fragility was building. When supply finally returned, the market would have to absorb all those overvalued cars. Dealers loaded up at the top, and buyers stretched themselves thin. The seeds of the collapse were planted during this boom. Every dollar added to the price today was a risk for tomorrow, and when the music stopped, someone would be left holding the keys. So, Carmax drops their second quarter numbers, and Wall Street panics. Their stock falls 20% in a single trading session, the steepest drop since the COVID crash. That's not a correction, that's a free fall. Analysts scramble to update their models. Headlines call it a bloodbath. Every major brokerage desk flashes red, and the sell orders just keep coming. Carmax's market cap loses billions before lunch. Investors who thought used cars were a safe bet are suddenly staring at double-digit losses overnight. It's not just about one bad quarter. The numbers are ugly across the board. Retail used vehicle sales down 5.4%, profits off by nearly a third, and the average selling price falling for the first time in years. But the real shock isn't in the earnings. It's in the reaction. When a company this size takes a hit, it's a signal. The phones light up at every dealership finance office. Lenders start asking hard questions about collateral values. Independent dealers watch the ticker and realize the floor just dropped out from under their inventory. On the analyst calls, there's no spin that can soften the blow. One bank downgrades the stock before the call even ends. Another warns clients that the entire sector is at risk. John Daniels, Carmax's own auto finance chief, calls the recent loan vintages tough, which is code for "we're bracing for more losses." The Manheim Index starts to slide, tracking the fallout in real time. Within hours, every major auto stock is down. Even franchise dealers, who don't compete directly with Carmax, feel the pain in their share price. This kind of drop isn't just about numbers on a screen. It's about confidence. If Carmax can lose a fifth of its value in one day, what does that say about the rest of the market? Dealers who bought inventory at last year's prices are now underwater. Lenders begin tightening up, pulling back credit lines. The shock spreads, not just through Wall Street, but through every used car lot in America. And for anyone holding a car loan or a lot full of inventory, the message is clear. The game has changed. Retail used car sales at Carmax just fell 5.4% year over year, landing at 199,729 units for the quarter. That's not a blip. That's a real drop in buyer appetite. Revenue missed Wall Street's target by over $450 million, with top-line sales down 7.2% to $5.27 billion. For a company that rarely misses by more than a rounding error, this is a warning shot. Even the average selling price slid from $26,245 to $25,993. So, not only are fewer cars moving, but each one is bringing in less cash. And it's not just about numbers on a spreadsheet. Showrooms are quieter. Sales teams who used to close deals in hours are now watching cars sit for weeks. Managers talk about soft demand and consumer fatigue, but the reality is simple. People aren't buying like they used to. Inflation and higher interest rates are squeezing wallets, and even buyers with good credit are holding back. Carmax's CEO, Bill Nash, admits that sentiment is strained. Even solid buyers are sitting on the sidelines, he told analysts. That's a problem when your whole business depends on steady turnover. The digital side isn't bailing them out either. Carmax pushed hard on its online platform, hoping to pick up slack from in-store sales. But the numbers show that channel flatlining too. The company's bet on omni-channel retail, buy anywhere, deliver anywhere, hasn't stopped the slide. Same-store sales fell 6.3%. That's the worst streak since the early days of the pandemic. With fewer cars selling and prices dropping, profit margins are getting squeezed from both ends. Dealers who loaded up on inventory last year are now underwater. Cars bought at peak prices can't fetch anywhere near what's owed on them. Lenders are watching these sales numbers and starting to worry about collateral values. When the biggest player can't move the metal, smaller dealers start to sweat. And if this trend keeps up, the pain won't stop at Carmax's front door. It'll ripple through every lot, every lender, every buyer still hoping their trade-in is worth something. Carmax isn't just a car dealer, it's a bank too. Their auto finance division, CAF, holds nearly $5 billion in car loans right on the balance sheet. That's not counting the billions more they've packaged and sold to investors, but still manage behind the scenes. Every time a buyer drives off with a Carmax loan, the company is betting on their ability to pay, and betting even harder that the car itself will hold enough value to cover the risk if things go sideways. But when used car prices fall, that bet gets dangerous. Carmax has to set aside money, an allowance for loan losses, every quarter. This is their buffer for when customers stop paying and cars come back as repossessions. As of the end of fiscal 2025, that allowance reached $458.7 million, which is 2.61% of all the loans they manage. That's not a guess. It's a calculation based on how many loans are going bad, how much they're recovering at auction, and how quickly the math is changing as prices slide. Just last quarter, Carmax bumped that allowance by 26.3%. That's a $71 million jump, mostly tied to loans written in 2022 and 2023. Those years were the peak of the frenzy. Cars were expensive, buyers stretched, and loan-to-value ratios soared. Now, as prices drop, the value of those cars doesn't come close to what's still owed. When a borrower defaults, the recovery at auction is a fraction of the original loan. For some recent repossessions, Carmax is only getting back 35 to 40 cents on the dollar after fees. That's loss severity at levels the company hasn't seen since the Great Recession. The numbers get worse when you look at the broader pool. Carmax manages about $17.6 billion in auto loans, combining what's on their books and what's been securitized. The allowance may look like a big cushion, but it's thin if the slide continues. A 20% drop in wholesale prices can double the losses on the riskiest loans. Stress tests run by rating agencies show that a sharp, sudden correction, like what just happened, can push cumulative losses for certain loan groups to 8 or even 10%. That's enough to trigger alarms with investors and force Carmax to set aside even more capital, eating into future profits. It's not just about the numbers on paper. Every time the allowance rises, it's a direct hit to earnings. Wall Street doesn't like surprises, and a reserve spike is the kind of surprise that makes analysts nervous. The last time Carmax's provision for credit losses jumped this much, the stock took a beating. Investors know that these reserves aren't theoretical. they're a real cost, and they signal that management expects more pain ahead. The fragility is baked into the system. Carmax's average borrower has a FICO score just under 700, with loan-to-value ratios often around 100%, sometimes higher for deals done at the peak. That means many buyers walked out with little or no equity. If values fall, they're underwater almost immediately. And when people owe more than their car is worth, defaults rise. It's a chain reaction. Prices drop, recoveries shrink, losses pile up, and the allowance grows again. There's another layer too. Carmax funds much of its lending through warehouse lines and asset-backed securities. These deals have triggers. If losses or delinquencies spike, cash gets trapped and can't flow back to Carmax. That's a liquidity risk, and it's why the company has to keep a close eye on its reserve math. If the market gets any worse, those triggers could trip, cutting off a key source of funding just as losses are accelerating. So, while the headlines focus on falling sales and shrinking profits, the real danger is in the loan book. A $5 billion exposure means Carmax is carrying the risk for every bad loan, every underwater borrower, and every car that's now worth less than the debt attached to it. The allowance for loan losses is the canary in the coal mine, and right now, it's getting louder every quarter. Wholesale auctions are supposed to be the safety valve of the used car business. When a dealer gets stuck with too much inventory, they offload it at auction, take the hit, and move on. But when a heavyweight like Carmax moves thousands of vehicles at once, it's not just a safety valve, it's a tidal wave. The difference is scale. In July and August, dealers started whispering about massive Carmax blocks hitting the lanes. One auction in Atlanta listed nearly 3,000 Carmax units on a single day, more than some regional chains sell in a year. The kicker? These cars didn't just clear at the going rate, they hammered at 10 to 15% below the Manheim Market Report, the industry's main pricing index. That's not a markdown, that's a fire sale. The immediate fallout showed up in the numbers. Manheim's index dropped 8% in just 2 days after that auction. For context, that's the kind of move you'd expect over a bad quarter, not a single week. Dealers who had just stocked up at higher prices saw their equity vanish overnight. Some called their floor plan lenders for relief, only to be told their credit lines were getting cut. The pain didn't stop at Carmax's door. It rippled out to every small lot that depends on auctions to survive. But here's where things get strange. VIN trackers, those tools that let you follow a car from dealer to auction and back again, started picking up patterns. Clusters of Carmax vehicles were moving through shell wholesalers, sometimes relisted at other auctions, sometimes exported out of the country. It looked less like a routine inventory dump, and more like a deliberate effort to move volume off the books as fast as possible. Some insiders speculated that Carmax was using these channels to hide how much inventory they were really unloading, keeping the worst of the price collapse out of their own reported numbers. The effect was brutal. When a block of 3,000 cars clears at a steep discount, every similar car at every other auction instantly loses value. Dealers who thought they had a cushion suddenly found themselves underwater. Some tried to hold out, hoping prices would recover. But when the index drops 8% in 48 hours, hope isn't a strategy. A few walked away from their floor plans entirely, unable to cover the losses. That's not just a bad week. That's a business-ending event for a lot of independents. Carmax's own explanation? They say the market forced their hand. CEO Bill Nash told analysts, "We're responding to consumer demand and inventory realities." But off the record, some competitors see it differently. One dealer owner, who asked not to be named, said, "Dumping that many units at once, at those prices, is like dropping a bomb. It wipes out everyone who can't take the hit." And the numbers back it up. After the biggest Carmax auction days, Mannheim's wholesale index didn't just dip, it cratered. The average value of late-model sedans and SUVs fell faster than at any point since the 2008 financial crisis. For certain models, prices dropped by as much as 20% in a month. That's not a correction. That's a collapse. The deeper you look, the more it feels like price weaponization. When a national player can move thousands of units below index, they're not just clearing old stock, they're resetting the market. Every dealer, every lender, every buyer is forced to reprice overnight. And with VIN clusters suggesting off-book pathways, the true scale of the dump might be even bigger than what's visible in the auction data. This is how a single move becomes a market event. It's not just about Carmax's balance sheet. It's about the downstream carnage. Dealers lose their shirts, lenders pull back, and the average buyer finds out their car is worth thousands less than they thought. The auction block isn't just where cars change hands. It's where fortunes are made and lost, sometimes in the space of an afternoon. A dealer sits alone in a dark office, phone silent, wondering what to tell his staff. 2 weeks ago, he had 8 people on payroll and a lot full of trucks and SUVs he thought would sell. Then came the auction collapse. Within 48 hours, his floor plan lender locked his credit line. The bank's message was blunt. Your collateral isn't worth what you owe. No warning, no negotiation. One day he's a business owner. The next, he's locked out of his own inventory. He's not alone. Across the country, independent dealers who stocked up during the boom are now staring at 6-figure losses. Some watched $500,000 in inventory lose $200,000 in value almost overnight. Cars that cost $30,000 at auction last summer can't fetch $18,000 today. The math doesn't work. There's no way to sell out, no way to refinance. Every call to the lender ends the same way: pay up or get out. Staff meetings turn into layoff notices. There's no money left for payroll, no hope of moving metal before the next payment comes due. Some owners try to hold on, burning through savings and hoping for a rebound. Others walk away, keys left on a desk, dreams shuttered. The ripple isn't just financial, it's personal. 8 families lose a paycheck because one auction block in Atlanta cleared at a fire sale price. Dealers talk about sleepless nights and the shame of telling employees there's no work. One owner, who asked not to be named, said, "I watched everything I built disappear in weeks. Our doors are shuttered. Our floor plan called. I'm ruined." His story is echoed in forums and industry groups, where the only advice left is how to liquidate and move on. This is what a market collapse looks like at ground level. It's not just numbers on a screen or headlines about falling indexes. It's a business owner watching years of work vanish, staff packing up their desks, and families scrambling to cover bills. The fallout from a single auction can wipe out a decade of effort. For every big player that shrugs off the loss, there are dozens of small dealers who never recover. So here's where the spiral really kicks in. Deep in the fine print of Carmax's loan funding deals. Every time a customer drives off with a Carmax loan, that paper might end up bundled into an asset-backed security, or ABS. These deals are supposed to be safe, but they come with tripwires, covenants that tie the whole structure to the value of the cars themselves. And when prices drop fast, those tripwires get tested. Let's talk numbers. A 25% drop in wholesale used car prices isn't just a bad headline. It's the line where the math turns lethal. If too many loans go bad, or if the cars backing those loans lose enough value, the ABS deals start to fail their over-collateralization tests. That means the pile of collateral, cars and payments, no longer covers what's owed to investors. In a typical Carmax ABS, the threshold might be as low as 5% cumulative losses in the first couple years, maybe 7% after that. If losses spike past those levels, the deal locks up. Cash that would normally flow back to Carmax gets trapped inside the trust. Senior investors get paid first, and Carmax gets nothing until the shortfall is fixed. That's a cash trap, and it's written into every contract. Here's how it plays out. Carmax's 2022 and 2023 loan vintages are already showing loss rates above 3%. And that's before the worst of the price collapse hit. If the market tanks by 25%, recovery rates on repossessions crash. Instead of getting 60 cents on the dollar, Carmax might only see 35 or 40. That alone could push cumulative net losses on those pools to 8, 10, even 12%, well beyond the triggers. Once that happens, every dollar from those loans gets locked up to pay senior bondholders. Carmax loses access to the residual cash it counts on to fund new loans, pay down debt, or just keep the lights on. It doesn't stop there. The same triggers apply to the warehouse lines Carmax uses to fund its loans before they're securitized. If losses or delinquencies breach the covenants, those lenders can demand immediate repayment or cut off funding entirely. That's a liquidity crunch. No new money coming in, just as losses are accelerating. And with over $4.8 billion in loans sitting on the balance sheet, that's not a small problem. The signals aren't hidden. ABS trustee reports, rating agency stress tests, and even Carmax's own filings all warn about what happens if used car prices fall too far, too fast. Analysts watch the allowance for loan losses and the delinquency rates every quarter, looking for signs that the triggers are about to trip. If the numbers get bad enough, the market knows it before Carmax can spin the story. Investors start asking if the company has enough capital to weather a cash trap, or if it'll be forced to sell more inventory at even lower prices to raise cash, feeding the spiral all over again. That's how a market correction becomes a crisis. The mechanisms are all there. Price drops, breach triggers, cash traps, and liquidity dries up. It's not just about selling cars anymore. It's about whether the whole funding machine can survive a sharp enough shock. And in this environment, the shock isn't theoretical. It's happening in real time. Carmax's $4.8 billion in auto loans and its position as the nation's largest used car retailer made its recent warning a seismic event for the industry. The documentary traced how, after the pandemic, a supply crunch drove used car prices to record highs, leaving the entire market vulnerable. Recent SEC filings confirm Carmax's spike in loan loss reserves, and independent auction data shows used vehicle price indices have dropped by as much as 8% in recent quarters. Yet, no public documents verify the claim of a 67% industry-wide value collapse overnight, nor is there disclosed evidence of a single 3,000 unit below-index dump driving the market. What is clear? A large player's moves can ripple through dealer credit lines and consumer equity, tripping stress covenants on billions in auto loans. The full mechanics of Carmax's wholesale strategies and their long-term effects remain partly classified or undisclosed. The used car market's stability now depends on transparency and on how quickly dealers, lenders, and regulators can adapt to shocks that no longer unfold slowly.